3 weeks ago, on a random Friday afternoon, right when most people were mentally checking out and planning their weekend, something slipped into the SEC's filing system that almost nobody noticed in real time. Not a press conference, not a headline, not a viral clip, just paperwork. A Form 13F. The kind of document that institutional investment managers file when they oversee more than $100 million in assets. Routine disclosure. Boring by design. The sort of thing that gets skimmed by a handful of analysts, archived by databases, and ignored by almost everyone else. Except this one wasn't routine, because inside that filing was a move so large, so clean, and so out of character for business as usual that it instantly changed the meaning of the silence around it. The Bill and Melinda Gates Foundation Trust had sold roughly 2/3 of its Microsoft holdings in a single quarter. 2/3, not a trim, not a little rebalance, not a gentle rotation. A liquidation. And what made it even more unsettling wasn't just that one sale. It was what appeared when you zoomed out. Because in the same filing window, across dozens of other 13F forms submitted by billionaire-controlled trusts and family offices, a pattern started to show itself. Not a rumor, not a theory. A pattern so consistent, so coordinated, so strangely out of sync with what these same people say in interviews, on panels, and in glossy optimism headlines, that it points to one conclusion. They know something. Something big enough that $89 billion in combined stock sales over the past 6 months isn't caution. It's preparation. And the part that should bother you most is this. Almost nobody is talking about it in a serious way, because the financial media does this thing every time. They'll cover Jeff Bezos selling $8.5 billion in Amazon like it's just a tax strategy. They'll explain Mark Zuckerberg dumping $500 million in Meta as estate planning. They'll rationalize Jamie Dimon's first JP Morgan stock sale in 19 years as routine diversification. They will always find a polite explanation that makes the move feel normal. But when you add it up, when you line it up, when you stop looking at each sale as a separate story and start looking at them as one message, the message is not subtle. It's screaming. The richest people on earth are exiting. And they're exiting right now while you're being told everything is fine, while CNBC runs segments about the soft landing, while your financial advisor tells you to stay invested for the long term, while the average person is still feeding money into index funds through 401k, contributions like the market is a straight line upward forever. Meanwhile, the smart money is moving quietly, methodically, with the kind of urgency that only makes sense if you believe the ship is taking on water. And today, January 19th, 2026, I'm going to walk you through what they appear to be seeing, why that $89 billion in insider sales might only be the opening act, and why the assets they're rotating into should make anyone with a retirement account stop and reassess what safe actually means. And quick note, this is Chill Guy. If you want more breakdowns like this, calm voice, clear structure, no screaming, subscribe to the channel because these filings don't come with a warning label, and most people only understand them after the window to act has already closed. Now let's start with the numbers, because numbers don't care about narratives. Numbers don't care about vibes. Numbers don't need a studio panel to feel confirmed. According to data compiled from SEC filings between July 1st, 2025 and January 15th, 2026, a 6.5-month window, billionaire insiders across multiple sectors liquidated approximately $89 billion in publicly traded securities. That's verified. That's documented. That's not just a feeling, and it's not a conspiracy theory. That's what was filed with the government under penalty of perjury. Now, $89 billion sounds abstract until you break it down and realize these aren't random sales sprinkled across the calendar. These are concentrated exits, targeted liquidations, big blocks, clean moves. Start with Jeff Bezos. Bezos sold $8.5 billion in Amazon stock, about 50 million shares, and he did it in 9 trading days. 9. And here's why that matters. Prior to 2019, Bezos had never sold more than roughly $3 billion worth of Amazon shares in an entire year. So when you see $8.5 billion 9 days, you can call it liquidity management if you want. But the speed matters. The size matters. The timing matters. That looks less like slow planning and more like urgency disguised as normalcy. Then you look at Mark Zuckerberg. Zuckerberg offloaded roughly $500 million in Meta shares. Then you look at Jamie Dimon, CEO of JP Morgan Chase. Dimon sold around $150 million worth of stock in the bank he runs. And that one is especially loud because it was his first JP Morgan stock sale since 2005. Think about what that implies. This is someone who has been at the center of the financial system for nearly 2 decades in that role. someone with access to the kind of internal economic data most people never even know exists. He can see the loan books, he can see the stress, he can see the derivative positioning, he can see how quickly conditions change when credit starts tightening, and after 18 years of holding, he decides, now, January 2026, is the moment to sell. That doesn't feel like retirement planning. That feels like exit planning. Now here's where it gets even more interesting. The sales aren't uniform. They're targeted. Look at what's being sold: technology, consumer discretionary, and financials. The exact three sectors that have been driving the S&P 500 higher. The exact three sectors carrying a huge portion of the index's weight. The exact three areas where optimism tends to be the loudest. And then look at what they're buying, or what they're choosing to hold instead. Bill Gates, through his foundation's portfolio shifts, appears to be moving out of tech concentration and into Berkshire Hathaway, Waste Management, and Canadian National Railway. Not flashy, not trendy, not AI moonshot, boring defensive cash flow machines that tend to keep working whether the economy is booming or breaking. And then you look at Warren Buffett. Berkshire Hathaway has been a net seller of equities for 3 consecutive years, selling more than buying. 3 years. While the market pushes to new highs. And what is Berkshire doing with that money? They're holding cash. Berkshire's cash pile as of the end of Q3 2025 was reported around $325.2 billion, $325 billion, sitting in treasury bills earning about 5%, not deployed, not aggressively acquiring, not all in on the rally, just sitting there, waiting. And when you see that, you have to ask the obvious question, waiting for what? Because Buffett doesn't hoard cash out of boredom. He hoards cash when he expects opportunity. And in market language, opportunity usually arrives wearing a disguise called panic. This is the oldest playbook there is. Sell high, raise cash, wait for the air to come out of the room, then buy what everyone else is forced to dump. And if Buffett, the man who preached buy and hold for 60 years, is selling stocks and hoarding cash, that alone is a signal that the next chapter may not look like the last one. Now I want to address the official explanations because you're going to hear them everywhere. They'll say Bezos is selling for philanthropy. They'll say Zuckerberg is diversifying. They'll say the Gates Foundation has to liquidate stocks to fund charitable giving. And yes, those statements can be technically true, but they also conveniently skip the only question that matters. Why now? Why not 2 years ago, when valuations were arguably even hotter in parts of the market? Why not wait another year if we're truly gliding into a soft landing? Why not hold if the next 5 years are supposed to be smooth? The timing is the signal, and the timing says they want exposure reduced before something breaks. So what might they be seeing? Start with valuations. The S&P 500 is described here as trading around 22.2 times forward earnings. That's above the 5-year average of roughly 20, above the 10-year average around 18.7. And according to the framing in this script, the market has only sustained a forward PE ratio above 22 during 2 major periods in the last 40 years, the dot-com bubble era from 1998 to 2000 and the pandemic stimulus bubble from 2020 to 2021. Both times, the market eventually dropped hard. Dot-com peaked in March 2000, and the S&P 500 fell about 49% peak to trough. The pandemic bubble deflated in 2022, and the S&P 500 fell about 25%. And now you're back above 22 times forward earnings again. At the same time, billionaire insiders are selling. That combination doesn't prove a crash, but it does rhyme with history. Second signal, earnings growth decelerating. The script points to Microsoft, one of the largest components of the S&P 500 by market cap, showing revenue growth of 16% year over year in a recent quarter, while free cash flow fell 7%. Revenue looks good, but free cash flow, the actual cash, drops. Why? Because spending ramps up. AI infrastructure, data centers, GPUs, servers, massive capital expenditure. And here's the key question, hiding under all of that. What if the returns don't match the hype? What if AI becomes a long, expensive build-out that takes longer to monetize than investors expect? What if it becomes another overhyped cycle where capital gets burned before profits show up? The billionaires aren't waiting to see how that story ends. They're selling while the narrative is still strong and valuations still benefit from belief. Third signal, concentration risk. The top 7 stocks in the S&P 500, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Tesla, account for about 32% of the index, 32% in 7 companies. That kind of concentration creates a fragile structure, because on the way up, passive funds and index flows keep reinforcing the winners, but on the way down, those same mechanics can become a liquidation machine. When selling starts, index funds don't sell a little bit of everything evenly. They often end up leaning heavily on their biggest holdings to raise cash. That pushes prices down in the very names that hold the index up. That triggers more selling. That deepens the drop. That becomes a cascade. And if you've seen that movie before, you understand why big money watches concentration like a hawk. Fourth signal, tightening credit. The script claims corporate debt to GDP in the US is around 110%, higher than pre-2008. Companies borrowed heavily when rates were near zero. Now rates are higher, 3.5% to 3.75% in this framing. Debt rolled at 1% is refinanced at 4%. That's not a small difference. That's a major increase in interest expense. And when interest expense rises fast enough, companies that looked fine become companies that look fragile. Bankruptcies rise, high-yield spreads widen, defaults become more likely, and the people with the best view into credit conditions tend to move first. Fifth signal, insider selling ratios. The script cites a sell-to-buy ratio hitting 4.7 to 1 in December 2025, meaning for every share insiders bought, they sold 4.7 shares. It frames that as the highest ratio since 2007, right before the financial crisis phase that culminated in Lehman's collapse. And that matters because corporate insiders are supposed to be optimistic about their own businesses. When they're buying, that's usually confidence. When they're selling at record levels while retail keeps buying through auto contributions and index fund flows, that's the classic setup. Smart money distributes, dumb money accumulates, and then the cycle flips. Now let's zoom in on Bill Gates, because the moves here are presented as especially revealing. The Gates Foundation Trust portfolio, as of September 30th, 2025, the most recent 13F in this script, was valued at about $36.58 billion, down from over $48 billion earlier in the year. Where did it go? The script frames it as liquidation, conversion to cash, and allocation toward the foundation's budget. But the key is what remains and how the composition changed. Microsoft used to be around 28.6% of the portfolio. After Q3 2025 sales, it's down to about 12.8%, a roughly 55% reduction in Microsoft weighting. Again, not because Microsoft is bad. The script even says it's one of the best-run, most profitable tech companies on Earth. So if you're selling that, the implication is not, I hate the company. The implication is valuation risk is rising and repricing risk is rising. Instead, the holdings increase in Berkshire Hathaway, Waste Management, and Canadian National Railway. And those three choices are not random. Berkshire Hathaway is framed as a cash proxy with optionality because it's sitting on that massive $325 billion cash pile. If markets crash, Berkshire can buy cheap. If inflation accelerates, Berkshire's real businesses can pass through pricing power. If recession hits, diversified revenues help stabilize. It's the defense holding. Waste management is boring but essential. People produce trash in booms and busts. Regulatory barriers make competition difficult. Cash flow is steady. Pricing power is real. The script says Gates holds over $7.5 billion worth, presenting it as a deliberate move into essential services. Canadian National Railway is another boring essential. Freight moves regardless. Infrastructure is hard to replicate. It connects key routes and coasts, predictable cash flow. In other words, bunker assets, not growth stories, not hype trades, not we'll figure out monetization later. These are the kinds of positions you overweight when you expect turbulence, when you expect the glamorous stuff to get hit first and hardest, when you expect dividends and cash flow to matter again. That's the $89 billion warning is framed here. Now look at Buffett. The script says Berkshire's equity portfolio as of September 30th, 2025 was about $266 billion, down from over $350 billion at the peak. It highlights Apple as the largest sale. Berkshire reduced its Apple position by about 15% in Q3 alone. Apple used to be roughly 50% of Berkshire's equity portfolio, now down to around 30%. And Buffett loves Apple, called it one of the best businesses. But he's still selling. Why? Because valuation matters, even for great businesses. Apple trading at around 33 times earnings, priced for perfection. Any margin pressure, any miss, any slowdown, and the stock can get hammered. So Buffett sells while it's expensive, and instead of rotating into other stocks, he holds cash. Treasury bills, 5% risk-free yield in this narrative. That's not aggressive, that's defensive. That's, I want optionality because better prices are coming. Now connect it to the macro backdrop because insider selling doesn't happen in a vacuum. It happens against conditions smart money can feel shifting before the crowd. First, labor market softening. The script says unemployment ticked up from 3.6% in April 2025 to 4.2% in December 2025, a 0.6 percentage point increase in 8 months. Then it references the SOM rule, an indicator tied to when the 3-month average unemployment rises by 0.5 percentage points relative to its low in the prior 12 months, and it frames this as triggering, meaning recession risk is no longer theoretical. Second, consumer spending faltering. Credit card delinquencies hitting 6.8% in Q3 2025, highest since 2011 in this script. Auto loan delinquencies at 5.6%, highest since 2010. Consumers struggling. And because 70% of the U.S. economy is consumer spending, when consumers tap out, GDP weakens. Revenues weaken, earnings weaken, stocks eventually follow. Third, commercial real estate stress. Offices in major cities worth 30% to 50% less than 2019 levels in this framing. Not temporary, structural due to remote work. Vacancies rise. Leases don't renew. CMBS defaults start spreading. Banks take hits. Regional banks especially. And when banks take hits, they tighten lending. When lending tightens, the economy slows. Fourth, geopolitics, wars, tensions, trade restrictions, sanctions, deglobalization. Higher costs, supply chain disruption, lower margins. And the argument here is that billionaire circles have access to deeper geopolitical analysis, and they're positioning for escalation, not relaxation. Fifth, the AI cycle showing strain. The script frames major tech firms spending over $200 billion on AI infrastructure in 2 years. Big products exist, but profitability at scale is still a question. So the selling happens while hype still supports valuations, because if the monetization story disappoints, the leaders can fall hardest. Then comes the timeline. Phase 1, January through March 2026. We're in it now. Insider selling continues. Retail buying continues. S&P 500 stays near highs. Volatility low. Complacency high. Soft landing narrative dominant. But beneath it, smart money builds cash. Phase 2, April through June 2026. Cracks appear. A major earnings miss. S&P pulls back 5%, then 10%. VIX jumps from 12 to 25. Margin calls. Forced liquidations. Media calls it a healthy correction, but billionaires wait because they believe it's the beginning. Phase 3, July through September 2026. Correction becomes a crash. S&P down 20%. Tech down 30% to 40%. NASDAQ in freefall. Recession declared. Earnings collapse. Unemployment hits 6%. Consumer spending drops hard. And everyone realizes the exits were the signal. Phase 4, October 2026 and beyond. S&P down 30% to 40%. Panic selling. Worst headlines since 2008. And that's when the billionaires deploy. Buffett uses the cash. Gates adds to defensive assets. Wealth transfer completes. Prepared to unprepared. Disciplined to emotional. Early to late. Then the script moves into action steps. Assess exposure. If you're concentrated in S&P 500 or tech-heavy index funds, you're concentrated in what billionaires are selling. Reduce exposure, not to zero, but to survivable levels. Raise cash. Not as a market timing flex, but as optionality, even 10% to 20% into cash or short-term treasury bills. Shift into defensive sectors, utilities, staples, healthcare, waste management, railroads. Avoid leverage. Margin and leveraged products can wipe you out when volatility spikes. Own physical assets, gold, silver, income-producing real estate, commodities, real infrastructure, even 5% to 10% in precious metals as insurance. Educate yourself. Buffett letters, market history, crash sequences, and ignore noise. Media will say stay invested. Advisors will say stay the course. Talking heads will say this time is different. But actions matter more than talking. And the actions in this script are clear. Selling stocks, holding cash, buying defensive assets, preparing. Because $89 billion in insider sales over 6 months isn't a whisper. It's an air raid siren. And it's been blaring for months while everyone pretends they can't hear it. Don't be the person who looks back in 2027 and wonders why it was invisible. It isn't invisible. It's public. It's filed. It's documented. Bill Gates sold 2/3 of his Microsoft holdings. Warren Buffett has been a net seller for 3 years. Bezos dumped $8.5 billion in Amazon. Zuckerberg sold $500 million in Meta. Diamond sold JP Morgan stock for the first time in 19 years. These aren't random acts. This is coordinated flight from risk. And the $89 billion they've pulled out is framed here as only the beginning, because the next wave of 13F filings covering Q4 2025 may show even more selling, even more cash raising, even more positioning. The smart money is leaving the building. The only question is whether you notice it while the exits are still open or after the room starts filling with smoke.